Are you invested in the S&P 500? If you are, this is the video for you because Goldman Sachs is saying there is a very gloomy outlook when it comes to that S&P 500 over the next 10 years, looking at an index growth of around 3%. Now, over the last 10 years, we have seen roughly 13% annualized return of the S&P 500, so it is a drastic reduction when it comes to the build. Now, Goldman Sachs overall, they think it is really due and it is going to be a dismal decade is what they're calling it because of the market concentration and that the current rank is near 100-year highs. So that can be a little bit concerning, which I want to break down. And also, I do want to share with you the alternative that they're looking for from the Monty Fool and how they are kind of breaking this down. So when you start looking at the S&P 500 funds, the index that tracks the S&P 500, these funds are weighted and they are market cap weighted, meaning that there is a much heavier concentration on these mega large companies. When you start thinking of Apple, when you think of Nvidia, when you think of Microsoft, the market mega cap companies are really the majority of the S&P 500 when you start looking at it. Now, looking at something like an equal weighted index fund. Now, this is a lot different than our traditional S&P 500, those like the VOO. With an equal weighted, it puts an equal weight onto every single company, regardless of the size of the company. So it is the exact same investment kind of strategy, but it is a different market weight that is really taken in point. If we point to the midcast of the forecast and assume an equal weight index will beat the S&P 500 over the next 5 years, they are thinking the expected return on this over a decade compared to what they're forecasting for a traditional S&P 500 fund, they are saying it is going to beat it roughly 240%. So on one side, we have really the traditional weighted by market value, and then we have the equally weighted value, and it is kind of the combination of both of those, or really the pros and cons of both of them. And again, when we start looking at the traditional S&P 500 fund, it is weighted, like we said, by market value, meaning when you look at Apple, Nvidia, Microsoft, and looking at the performance and the size of those companies, that is the majority of it. When we look at the Magnificent Seven, and if you're not familiar with it, quick Google search is going to show you this accounts for 1/3 of the index. That is right. 33% of the index is into 7 stocks that are in the S&P 500. That can be very scary. And the alternative to this is the Invesco S&P 500 equal weighted ETF. So the difference between it provides exposure to those same companies, but it eliminates the concentration problem that they're really talking about with Goldman Sachs by weighting each stock evenly. So even if you have a company, that is $5 billion and you have a company that is $5 trillion, which we haven't reached that figure yet, they are going to be invested into the exact same. The exact percentage is going to be in there. Now, the use quotes because really the problem is only being seen by them and a few other analysts. I see a lot of places where JP Morgan, Bank of America, a lot of other financial institutions and a lot of other experts are saying the S&P 500 is going to have stellar years in the future and they're going to continue. Now, the Magnificent Seven are some of the most fundamentally sound companies in the world, and these are global companies. When you look at their net profit margin, it is more than double that of the other 493 companies in the S&P 500. That just gives you a scale of magnitude that we see without these. However, when it comes to earnings growth, and this is again where it kind of gets interesting, the Magnificent Seven, they're expecting it to slow down significantly next year, while growth across the other S&P 500 companies is forecasting to accelerate. Now, this is something that we've seen and that, again, a lot of analysts have been talking about. When we start looking even outside of the S&P 500, that we're going to see an incredible amount of growth in the next 3 to 5 years out of our mid cap and our small cap ETFs and those mid cap and small cap companies that are contained in there, which could really make a difference for a portfolio. Where if you are holding everything just in the S&P 500, market weighted cap might really make a big difference if those larger companies are not doing as well as we think. And of course, there could be some significant headwind with the traditional S&P 500. Now, when we start breaking it down a little bit further into this ETF, the last item is the expense ratio. Now, the Invesco S&P 500 equal weighted ETF has a middling expense. That's what they call it, of a 0.2%. When we start thinking traditional S&P, it's about a 0.02, 0.03% when it comes to those, which means you pay $2 for every $1,000 you have invested, which is significantly higher than most of those S&P 500 index funds, but it is much lower than the industry average of a 0.36 across all US index funds and mutual funds within that category. So it does fall kind of right in the middle when it does come into that kind of middle weighted. So does it make sense? Now, this equal weighted S&P 500 fund really does make sense when it comes to hedging against the concentration risk of these large companies. When you look at me personally, I have a significant amount in the Vanguard S&P 500 fund, which of course is the VOO, tracks the traditional value market weight. I have no plans to change it. I'm not going to adjust it. I think it's pretty neat to see that maybe opening up a smaller position or putting it into addition could hedge against some of the concentration, because what could happen, and again, kind of just working on theory, if some, even looking at those 7 largest companies, if we see one of those companies, even 2 of those companies start to kind of level off, we're not seeing the growth, AI maybe not being as big as they really thought it was going to be, really overhyping that situation. If we start seeing these companies, their profits to urging their earnings ratio, their P&E ratios are super, super high. That is why they are saying the valuation is at a 100-year all-time high when it comes to here. But looking at that equal weighted index again, it seems like over the past couple decades, it has really underperformed than what we see again of the equal weighting. Since 1970, the equal weighting benchmark has beat the S&P 500 during 78 of the rolling 10 years by an annual average of 2%, according to Goldman Sachs. Now, when you start breaking it down, last decade, it did an absolute pattern reverse, meaning that when we started looking at the equal weighted benchmark, it wasn't growing and really didn't do anything in comparison to our traditional S&P funds. Now, in contrast or in context, makes the sense for investors to own positions in both the index funds and the equal weighted index funds to allocate it, really having a lot more convenience. I know it is going to be a lot of overlap, but when it comes to the weighted difference, this is also the big reason when I start looking at my 3 ETF portfolio, that is the concentration that I look at. So when I look at owning the QQQM, which is based on that NASDAQ 100, so it does look at those really big financial companies, and it is heavily vested in those financial companies. When I look at really my foundation and my core, I do invest in that VOO, that S&P 500 index fund, which again is the core, is the basis, making sure that we have the diversification within there across all of the different markets, all of those different sectors within the S&P 500. And the third one within that 3 ETF portfolio is, of course, our dividend generation. Right now, I do hold the HD. I've held it for a number of years. It has done incredibly well, not only with the dividend yield that we're getting back from it, but also with the growth factor that comes in hand with it. We're actually up, and I believe in one portfolio that we do hold it, which is my AdSense portfolio with the YouTube account that we have here. So if you like the content, guys, definitely subscribe to the channel. But overall, we're up, I believe, around 16% right now, which is kind of crazy, depending when you're getting in there. And of course, dollar cost averaging. I cannot stress it enough. Regardless of if you're in the equal weighted, if you're in the market weighted, it really makes a big difference when you're going and you're investing, not really lump sum investing, but dollar cost averaging into your investment positions. It does make a big difference buying when the market is up, buying when the market is down, really can make a difference in your investment portfolio. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.